Let's bring on board Ivy Subramaniam, Director at Quantum AMC. Ivy, hi, morning. How are you feeling about the market? The euphoria on Monday post the state election outcome and clearly the pullback yesterday of about 0.5%.
I wouldn't really look at the elections as a reason to stay invested or not to invest. As we have always been saying, elections really don't matter in the long run. What we need to look at is the underlying business conditions, and I think I indicated in your program a few months back that we were bullish on a lot of these capital goods companies, and that was largely due to valuation reasons. Things are still tough at the ground level. Most of the capital goods companies are still seeing lower order flows. But having said that, the valuations were so cheap a few months back that we were bullish and we bought into those stocks, and that has done well for us. Whether the outcome of the elections don't really worry us so much as what it does to the economy. And if you look at the last 30 years, Indian economy has grown at an average of around 6.5%, and that is irrespective of the different kind of governments which we have had over these years.
Right, so at the current juncture, do you think that markets are fairly priced because earnings have not bottomed out, and the only reason why markets have gone up of late is because the political uncertainty has taken a backseat for the moment?
Yeah, to some extent I would say that, from a valuation perspective, if you look at the Sensex, it doesn't really look very cheap. It's probably at the historical averages or even slightly above the historical averages. So you need to dig deeper to find out where there is value or where the stocks look very expensive. Again, going back, we were bearish on consumer staples because it was very expensive. And even today, despite the poor performance relative to the other sectors, it doesn't look cheap to us at this point in time. So we will keep digging and finding out where there is value. At this point, I don't think the stock markets in general look cheap. They do look at the historical averages, or even to some extent, in some cases, expensive.
Ivy, for last 3 years, defensive and predictable businesses or quality businesses have dominated not only Indian markets but global markets as well. Now that growth is making a meaningful comeback and growth could be the talking point for 2014, do you think defensive investing could take a backseat and growth investing could make a comeback, which is cyclical, banks and industrials?
Yeah, for fund managers who look from the point of view whether to be defensive or to be in growth stocks, it might make sense for them to shift. But having said that, for a lot of people like us who look at valuations, ultimately whether it's defensive or cyclicals, we need to look at whether the valuations look attractive. And there we do find sometimes even defensive stocks becoming cheap. So I cannot say that there will be an en masse move from defensive to growth stocks. The other point of worry is, while the growth looks good and things seems to be reviving, please remember there is still this huge tapering which needs to be done. And after that we need to see how businesses work or what happens to the world of business as well as finance. That risk still remains on the stock markets.
Ivy, what's the view on the power stocks? Because they've been holding out pretty well up until yesterday when the CERC guidelines came out and we saw the huge cracks coming in from NTPC to Power Grid to the rest of the space.
Yeah, so I'm still waiting for some more clarification on the exact implications of all these new rules. But having said that, these are draft guidelines and we still need to see whether that will actually translate into the final guidelines. But I think the stock price correction is good for us, because even if you take into account the new draft guidelines, I think at some point there is value in these stocks. So 11% decline yesterday in NTPC was to us an attractive point to look at these stocks again.
What is your take on the entire private banking space? Because the Indian private banking space could clearly be divided into 2 or 3 large parts. One side you got quality private names like HDFC Bank, IndusInd Bank. They are good but they are expensive. In the middle you got something like ICICI Bank, which has got size but it's got NPA concerns. And bottom of the ladder you've got the old private sector banks, names like Karur Vyasa Bank and Federal Bank. So what do you like within that group?
So, as you said, stocks like HDFC Bank definitely rate high in terms of management quality and the asset quality, but they are not cheap. And we did hold these kind of stocks till the beginning of this year, when due to valuation reasons and other concerns, we sold out of that stock. The kind of stocks which we like, if you look at our portfolio, which is available on the Quantum website, you will find that we still like stocks like ING Vaishya, where the asset quality seems to be under control and then their efficiency seems to be improving. So those are the kind of banks which we like. Some of the larger names which you mentioned, yes, we still have concerns on the non-performing assets, and even if you account for them in terms of giving them lower multiples, it still doesn't give us great confidence to buy into those stocks. So we are staying away from those kind of banks.
Ivy, what's the call now in IT? Because clearly it seems like with all uncertainty, the market keeps coming back to IT, which has already outperformed.
Yes, it's one of those sectors which continues to generate decent amount of cash. It's a sector where it's unlikely that there will ever be a capital call on you from these kind of companies. Businesses are reasonably stable and things seems to be picking up for them, and rupee depreciation does help them at least in the near term. Long term, of course, they need to rejig their business models, so we need to look at business models and managements which could execute those kind of business models. So net, we have always been liking that sector, even at the start of the year when questions were being raised on the IT sector in general and certain companies. We felt that the business model was still robust and there were some very good managements to back, and we continue to hold these stocks.
But Ivy, IT stocks, at least large cap IT, has seen an extraordinary run-up. Stocks like HCL Tech, TCS, even for that matter Wipro, they have appreciated quite smartly from the low. So on top of a good 2013, do you expect a good 2014 as well? Or for the moment, at best, IT would be a market performer?
See, for me, it's very difficult to say how others would view it, and therefore whether, they find greater value or greater growth momentum in other sectors relative to IT. So that will decide the fate of these stocks. But from a business point of view, as I said, we still like it. But having said that, a run-up like this, which took place in the IT sector, would definitely make us rethink on the weights which we should have. So we were very bullish on this sector. We were overweight. So if the index had a 6% weight on X stock, we would normally have around 6 or more than 6% weight on these kind of stocks. But now, having seen the run-up, they are not as cheap as they were at the start of the year. We did trim and we have reduced our weight in that segment.
I mean, what is
but we still like it and we will continue to hold it for some
Fair
more.
point. So what is your template for 2014? What is your big assumption for 2014? Because in 2014 we are pitted against elections. We surely will get a sense on tapering, and hopefully in 2014 we will also get a sense on what is happening to China and to Europe.
Yeah, see, these are all macro events which both in terms of timing, in terms of impact, very difficult to judge when it would happen or what it will do. You need to go back to the companies you are investing and then try to identify those managements which can survive this topsy-turviness which can happen due to elections, due to politics, due to, pullback or tapering. All these things will make certain managements react in certain ways, and that is what you should be backing. So at the end of the day, while I worry about this macro scenario, we don't really construct our portfolio based on that. We would go back to look at what's happening in automobile sales, what's happening in cement sales, where does the valuation look like. Those would be the deciding factors. That to us, despite all the elections, despite the tapering, we like certain segments. Although the portfolio has some amount of cash, But the stocks which we hold, we still like those kind of managements, and we think they will continue to thrive even in a very difficult environment like change in government, tapering, or a Chinese slowdown. Despite that, these managements would do well, and that's what we are backing right now.
What happens then to the names from the auto space, Ivy? Because again, the resilient ones from yesterday were a couple of auto names as well, the likes of a Hero MotoCorp, or for that matter, Bajaj Auto, and this is despite of a slowing down, monthly sales data.
Yeah, see, you need to keep aside what happened yesterday or day before yesterday, or even for that matter for the last 1 month or a week. Stock prices could move for a variety of reasons. I do agree that the automobile sales has seen considerable amount of slowdown, but is that going to be the case for the next few years? I don't think so. You do know that many cities are coming up and there is a need for good transportation systems, and with the lack of adequate public infrastructure in terms of trains or buses, you require a private vehicle like two-wheelers. And all the larger names which you mentioned, Bajaj or Hero Motors, I think they all have great products at good price points, which will continue to meet those demands. So yes, there is a slowdown now, but if the stock prices become cheap, great time to add more into those kind of stocks.